Coming up today, stocks trade flat, Mag 7 continues to struggle, is the AI panic over, will there be a disruption in credit markets, new Chinese humanoids, inflation continues to trend lower, and the latest moves from the biggest and best investors in the world. You got to see this, guys. Let's go. And welcome back, guys. On this shortened trading week, was a public holiday yesterday for President's Day. Markets opened up a little quiet on the index level, but as usual, we've got a lot of big moves going on underneath the surface. Still plenty of dispersion, plenty of checkered breadth across the board, not just with stocks, but at the asset class level as well. Commodities and crypto still under pressure, whilst bonds are continuing to hold their ground after catching a bid there last week, along with international markets continuing to outperform year to date. In fact, making the relative performance of US stocks the worst year to date performance that we've seen over the past 30 years. In a continuation from last year, international stocks really outperforming. But that isn't stopping American corporate insiders from buying their stocks. In fact, they've actually been steadily accelerating. And according to sentiment traders, sustained accumulation phases like this one have been uncommon and historically tended to appear months ahead of time of some of the market's stronger advances. You can see that in this chart here. Whenever there's a cluster of corporate insider buying, that's executives buying their own stock, that typically bodes well for the market overall going forward. But just looking at the latest moves from billionaire fund managers, starting off with Warren Buffett's Berkshire Hathaway, as we're just getting their Form 13Fs come through. Now that we're 45 days into the quarter, they're obliged to report all their trades for the previous quarter, Q4. We can see Berkshire Hathaway been adding to its fifth largest position in Chevron Corp, large oil producer, Chubb Limited, and interestingly, Domino's Pizza, whilst reducing their position in Apple and Bank of America. Just looking at some other big investors like Viking Global, adding to its largest position in Microsoft, Taiwan Semi, Visa, Walt Disney, McDonald's, and some of these hedge funds like ValueAct that have really good long-term track records have already started buying software stocks in Q4. Remember, they've already been downtrending for a few months, really getting hit hard in the last few weeks. So I can imagine we're going to see more of these software stocks and others that have been hit hard from the perceived threat of AI disruption, like Salesforce, getting added to big investors' portfolios. As we've got plenty of stocks and bear markets underneath the surface, like Amazon, which Bill Ackman added to significantly in Q4 and also initiated a position in Meta and trimming some of his other positions, including Alphabet Google, by 86% after the monster run-up over the last year. Seth Klarman as well, another great investor, buying the dip on Fidelity National Information Services and Fiserv, two stocks that have been under a lot of pressure of late. He appears to see value there. Well-known investor David Tepper as well. He actually went the other way to Bill Ackman, added to his Alphabet Google stake and reduced Amazon. But he too also added to Meta, Taiwan Semi, bought the South Korea equity ETF, and appeared to have trimmed his Chinese position. And Charlie Munger's protege, Li Lu, initiated a small position in Crocs, the shoemaker, which looks to be already paying off after they just gapped up last week on better than expected earnings. And also, guys, if you're interested to know what stock I think could actually be the next Nvidia in terms of potentially making a big move like Nvidia has done, and that's because I think they could be one of the biggest beneficiaries of AI's next leg up, where it's all going to next, agentic AI. If you want to find out what stock that is and why I've invested in it, then click the link below this video, head on over to my site, click capital.io, and enter your email address to get my free report on this stock and learn why I think it has huge potential, as I believe it's significantly undervalued right now and currently under the radar for most investors out there, and that's because it's a small mid-cap. It's been making big moves in agentic AI, so check that out if you're interested. But it's getting back to the Mag 7. Believe it or not, we've got Amazon and Microsoft technically in a bear market, off more than 20% from their highs. In fact, every Mag 7 stock is down year to date. They're negative as a group, and we can see that looking at the Mags ETF. In fact, now down almost 8% year to date, but sitting right on the 200-day MA here in the gray line, which interestingly enough is also the anchored VWAP from the April lows last year. And that's the volume weighted average price ever since the market bottom. It bounced right off that today. Could be a little bit of a line in the sand here, as we've definitely seen a huge rotation this past couple of months into small caps at a mega cap tech, the Russell 2000, which is something we'd been forecasting as we had gotten to a record valuation gap between smalls and bigs. Earnings growth momentum coming back to small caps, prospect of lower rates, and big institutional money is still significantly underallocated to small cap. Still a lot of room to run here in this trade. As the big mega cap tech stocks continue to remain under a lot of pressure, we've got Amazon down 22% from highs, losing almost $500 billion in market cap. Microsoft doing even worse, now down almost 30% just in the last couple of months. Heaps of investors out there believing this stock was indestructible, but the market just proves once again, even the biggest stocks can make big moves, even if the indices are not. And what's really holding up the indices is other big stocks like Apple, not too far off highs, Nvidia as well, and Alphabet Google, currently testing a short-term support level here at $300 a share. And outside the Mag 7, we've got stocks making gigantic moves all over the place as the latest advances in AI have kind of lifted the rug and sent out ripples all across the place. Some of the volatility we've seen has been incredible. I'm not just talking about the Mag 7, some big companies out there, S&P Global, Salesforce, Adobe, big $100 billion market cap companies trading like penny stocks. AI is really shaking things up on a large scale. Entire sectors getting caught in the crosshairs as the market scrambles to price in this new reality. Really born out of Anthropic's release of Claude Code and their plugin, giving rise to the perceived threat of easily created tools wiping out software as a service business model. But this is a trend that's been in place for over 6 months now. It's just really exacerbated this last month. You can see here in the blue line and pink line is UBS's AI winners basket. In the orange and black line, software SaaS and stocks with a lot of AI risk, really diverging here. And we may not have seen the worst of it. The Jaws gap between these two groups could really open up over the coming weeks and months, as the premium valuation for non-capital intensive businesses versus capital intensive businesses has a nosedive. The only other period we've seen a similar discounting is back in the GFC. It's been a ferocious move by the market here, in tandem with a bit of a move back into value, small caps, international market, as growth had been significantly outperforming for about a decade. Doesn't mean it's completely over though. Big hyperscalers still pouring every dollar they can into building out AI infrastructure and compute. Meta expanding its Nvidia deal to use millions of AI chips, as there's still an arms race going on for who's going to have the most compute. And that's why energy is such a big bottleneck to AI's growth. It's not the intelligence of the models, it's not chip design, it's the energy they need to all run. It's the only thing that's pretty much throttling their growth. At the same time, global fund managers still list the AI bubble as the biggest tail risk. Keep in mind, these surveys often make for great contrarian point, because fund managers' biggest perceived tail risks rarely play out. Interesting to note, inflation is a close second to AI bubble risk, along with a disorderly rise in bond yields. And just look at that divergence between the software sector ETF IGV versus the NASDAQ Qs. There's been a close correlation for years there. That's completely fallen apart so far this year, and just technically speaking, could be in the process of putting in a bottom here. This increased volume, the price is grinding, bit of a bullish divergence on my DSI indicator here, but no doubt it remains under pressure as the market's trying to figure out all this new AI stuff, with many investors still worried that it could spill over to the credit market. We have seen some isolated pockets of bond yields and credit default swaps rising, as a lot of people believe these companies are spending too much on AI. There's not going to be a return. There's going to be a day of reckoning, and we could be on the cusp of a fresh wave of defaults. But overall, on the market level, we're just not seeing that. The US hyperscalers, corporate bond spreads, still hovering around a full point above treasuries, which was really no big deal. But this is also creating other halo effects, like we're going to see an explosion in the amount of software and apps out there that's already been trending up for about a year now. The amount of new websites, Apple apps, and GitHub code. As AI can now easily code, that naturally increasing the volume of what can be produced. And this is at the software level, and I think we'll eventually see this in the physical level as well. Something Elon talks about, the cost of production going towards zero, and why he believes there will be a future of abundance, universal high income, even though he's admitted it may take 20 or 30 years to reach that. Could very well be the case, as I also think right now we're in the middle of a productivity boom that's going to continue showing up in the numbers over the coming months. And remember, GDP is a measure of goods and services produced, so that's a strong tailwind for economic growth. That's starting to see investors and consumers feel a little bit better. Bit of a bump up in sentiment surveys, consumer readings, the price of gas has come down, people's expectations of inflation has come down. But the US is still very much in a race with China, pretty much the only other country challenging America's lead in AI, which appears to be quickly narrowing. If not in some areas, the Chinese could be slightly out in front. We saw it last week with C-Dance, video generation. Hollywood's already going after them. suing for intellectual property, but I think the cat's already out of the bag on that one. We're going to see amateur-produced movies with production value that challenges that of Hollywood's best. I think probably even this year, we're going to see amateur-produced movies on YouTube that maybe one or just a couple of people have produced with a couple of $1,000 in AI tokens. And remember, right now is the worst all these AI models will ever be. They're only ever going to get better, and they're improving at an exponential rate, along with Chinese robots showcasing their latest humanoids from Unitree at their Spring Festival Gala. And apparently, these are real. This is not an AI generated video. Check it out for yourself. I'll play it here for you now. It's about a minute long. So pretty impressive, the agility and movement of these humanoids. If this video is indeed real, China has made a leap forward with their robotic technology and just showing America does have a legitimate competitor here. And you can imagine when they put these things into the military, that will be a game changer as well. Speaking on the Chinese, it's the year of the horse. Turns out animals that walk on four legs are historically better for stocks. The strongest 5 zodiac signs walk on four legs, while the worst 2 don't. Looking back in history, animals that walk on 4 legs, average return for the S&P's 10.9% versus 2 legs, 6.2%. Of course, that's just a fun fact. Correlation doesn't prove causation. What does have correlation with causation is leading cycle indicators, earnings per share, manufacturing ISMs, leading indicators, exports, bank lending growth, and survey demand, all curling higher of late. Great sign for the global economy and probably why global stock markets are also trending higher. Also very much curling higher, US data centers power demand as a percentage of the total, currently around 7%. I think this could hit a quarter of all US power demand come 2030. And there's already been a 40% increase in the price of electricity in the last 5.5 years. I think this is a good area for us investors to focus on upgrading of the grid, electricity generation, storage, and all the companies that go into the supply chain of power, I think have a strong tailwind. AI needs massive infrastructure, physical hardware to run on top. Even though there's a lot of disruption in the digital software space, AI needs real power to run on top of. I think that's going to be a big theme going forward, as it already is. Good thing is the rise in electricity is not showing up in inflation overall. Consumer prices. CPI on Friday coming in less than expected, as we've been pointing out. Trueflation showing the same thing. And looking at the latest real-time prices in the US economy, that should continue trending down, as Trueflation has about a 45-day lead on the official headlines we get from the BLS. So that's a good sign for the market. Definitely opens the door for Kevin Walsh to lower rates in June. Interesting to note on this US inflation map, it's not consistent across the board. We're seeing the lowest inflation in Texas actually getting slightly deflation there. We're still persistently high inflation in some of the western states and around New York as well. And there's a look at the interest rate probabilities. Market actually given about a quarter chance that Powell could do one last cut before he leaves. I highly doubt it, but nonetheless, the market still thinks that's a material probability, but not as much as when Kevin Walsh gets in there. Over a 60% chance he cuts right away, which I think he will as well. And an interesting chart of the long-term trend of interest rates going back over 700 years, with a linear regression showing the trend is clearly down. It's a lot more riskier for financiers to lend people money in the pre-digital age. And that's why bonds were more appealing than stocks, and why I believe stock valuations are also in a secular uptrend relative to bonds. Just over to crypto, Bitcoin and Ethereum still under a lot of pressure really hasn't been the same since October 10th when there was a big liquidation, unwinding. Apparently, a few market makers went out of business, kind of broke the correlation Bitcoin's had with tech stocks, even somewhat with gold and global liquidity as well. Massive divergence is going on, along with a strong correlation with software, Bitcoin and software, trying to put in a bottom here as we speak. We are getting a bit of a bullish divergence showing up. Fundamentals still improving with crypto adoption and use. Transactional volumes still hitting all-time highs, especially for Ethereum. Stablecoin usage, but just like software, the price action continues to remain under pressure here. As does silver. After that blow off top, it's lost its 50-day VWAP. Seems to be trading quite soft here. And crude oil as well, bumping around its 200-day moving average, $62 a barrel. And just looking at the Roundhill Generative AI and Technology ETF, ticker symbol CHAT, appears to be consolidating here. And I don't think a lot of people are truly ready for how much the world is already changing and will continue to change just in the next couple of years. I can't even imagine the level these chatbots are going to be at in 3 years from now. You look at how far they've just come in the last 3 years. Along with self-driving cars, which are basically already here, just mostly being held back by regulators. Software engineers barely writing their own code anymore. Humanoids, far more advanced than the public realizes. One person with AI is already more productive than 3 without. AI video creations moving at insane speed. Human creators look to be on a path of becoming obsolete. AI-driven biotech will cure diseases and make major discoveries soon. Solar and battery costs are falling rapidly, and I think the speed of innovation will only accelerate, making many jobs disappear. And there's 2 thoughts on the future of all this. One of abundance for everyone, which I'm not so sure about, or maybe it's so far away it's irrelevant. Another one is the permanent underclass. AI and those that own and use it become so big and powerful, it gives rise to socialism. And the government taxes all these big AI companies as a way to fund universal basic income. And as I've been saying for a while now, the best way to hedge against all of that is to participate, is to lean into it and own a piece of the AI pie, not just the biggest, most obvious companies, but also new emerging leaders in the field of agentic AI. I think there's huge opportunities out there for those that seek them, and the future will belong to those that use and own the AI agents. And that's why I'm super excited about this little known company that's currently being sold off, undervalued in my opinion, but could emerge as the next leader and offer up big returns, similar to what we've seen in Nvidia the last couple of years. And if you want to find out what stock that is with my deep dive report into it, then click the link below this video, head on over to my site, clickcapital.io, enter your email address, and then click on the big orange button, and my PDF report will be sent to your inbox right away, and you can read it. That's a wrap for the daily market review today, guys. Thanks very much for tuning in. My name's Jared, and I'll see you back here this time tomorrow. Cheers.